My name is Michael Duke, and on this channel, I like to cover stocks that I think are interesting, deep dive into them, analyze them in real time while you watch, and give my assessment on them. If that type of content interests you, then please consider liking this video and subscribing to my channel because despite taking the last few weeks off to enjoy the holiday with my family, I do this all the time. I also contribute to articles on Seeking Alpha of the stocks that I analyze. And of course, I am interested in the markets. I don't just talk about them, but it's where I invest my money as well. So, without further ado, today we will be talking about Parker Hannifin Corporation, ticker PH. This is a stock that I do own. I have a modestly sized position in this stock. Definitely has performed phenomenally well. It's tripled in the last 5 years. In fact, this is a chart. It looks like we start here at the tail end of 2014. Look at that chart. That is just a beauty up and to the right. So, as always, I'm going to talk about the company, what they do, a little bit about their history. I'm going to talk about what they sell, how they make money. Is there a narrative that's driving the stock price positively or negatively? We'll discuss if they have an economic moat around what they sell, as always. We're also going to analyze the financials, take a look at their valuation, and take a look at their dividend. We'll discuss the risks of investing in this company. I'll give it a grade, buy, hold, or sell, and then we will do our technical analysis. So let's get into it. Parker Hannifin Corporation, mid-cap company, or large cap. I don't know what the cutoff is exactly, but 82 billion market cap. Not the biggest, but pretty big. Here is their official summary, Seeking Alpha. Parker Hannifin Corporation manufactures and sells motion and control technologies and systems for various mobile, industrial, and aerospace markets worldwide. Company operates through two segments, diversified industrial and aerospace. The diversified industrial segment offers various motion control systems and components, such as active and passive vibration control, high purity sealing, coatings, high temperature sealing, cryogenic valves and fittings, HVAC-R controls and monitoring, elastomeric fabric reinforced metal, precision cut seal, hydrogen and natural gas filters, electric and hydraulic pumps and motors, industrial air gas filtration, electric and hydraulic valves, miniature pumps and valves, electromagnetic interface shielding, pneumatic actuators, regulators and valves, electromechanical and hydraulic actuators, power takeoffs along electronics, drives and controllers, process filtration solutions. Maybe it's better if we take a look visually at what the products are. We see here, this is just a visual of some of the things that they create. I do not manufacture machinery, so the specifics of what a lot of these components are go over my head, but I think what's clear here is there's a lot of very niche-y, very specific components that are either used in a very, very specific purpose or application, or in a broad application across many different contexts. So that's really interesting. What that implies to me is that there's a broad range of exposure here to a lot of different end industries. I mean, gosh, even down to the fact that they're selling tubing clamps, hose guards. You think about all the different places that an electric or a hydraulic motor could be: robotic arms, industrial, any sort of industrial machinery, robots, that type of thing, couplings, bearings, pumps. I mean, look at all the different types of pumps that they have: refrigeration and air conditioning, oil regulators, refrigerant valve. I do actually have some very, very, very basic experience with refrigeration. When I worked in real estate, we bought several buildings that were cold storage. These components do not look like industrial applications. They look like more residential applications. There are a lot of very small components. I mean, even look at this: seals and O-rings. These look like things that might cost $1 or something each, and be of a very specific size for a very specific application. Just look at all the valves that they sell. I mean, I'm not going to add up how many different product categories these are. These are all just categories. What this does imply is that there are thousands of different products. I mean, even bioprocessing, medical technology. So what does that mean? It actually means to me that there are a lot of different end markets for this company, a lot of different end customers. There's exposure to a lot of different areas of the economy, which is interesting. I like that. It basically it's kind of a proxy on the like back office mechanical components of a lot of different end parts of the economy, which I find really interesting when it comes to this company because uh, it's diversified. It has diverse revenue streams, rather, a diversification of end customers. So, what is the main thesis around investing in this company? Well, I think it's pretty cut and dry. The main thesis is it's somewhat of a proxy on just manufacturing growth, mechanical growth. And why is that such a story right now? Well, AI, data center demand, semiconductors, those are really, really hot right now. And then also aerospace. And to kind of lean on their uh, self reported measures here for a little bit more context here to go into what they do. So, we're going to come back to some of this when we're doing our financial analysis. This is what I want to highlight here. Uh, Number one position in motion and control industry. So, according to them, they have the number one market share in motion and control. Interconnected technologies and solutions across market verticals. 2/3 of our revenue comes from customers who buy four or more technologies or components. So, in other words, 2/3 of those customers are building some sort of machine or vehicle, aircraft, whatever, that are buying four or more components. That's interesting. You think about if you're, the company making the airplane or whatever, you got to source all these different uh, pieces of equipment. It actually does make sense to source more materials from singular suppliers, less points of failure, less points of contact, less paperwork. So that's interesting to me. Growth focused on faster growing, longer cycle markets and secular trends. So they say that there is a $145 billion market size, of which they have $20 billion of sales. That's a little bit less than what, like 13% of the motion and control industry. 33% being aerospace and defense, in plant and industrial equipment being the next, transportation, off highway, energy, HVAC, other. Here's what's really interesting about the aerospace portfolio. 38% of the sales are from commercial transport. So you actually see you've got your Boeing jetliners in here, the Airbus, and then we have whatever these are. Then we have our military Black Hawk helicopter, Apache, F-35, F-15. So there's commercial, and then there's military, and then the other segments there. Super interesting. So according to them, their competitive advantages are diversified customer base, comprehensive offering with proprietary design. So they will actually, what that sounds like to me is they will custom make components to go into these vehicles. 7% air traffic growth from 2023 to 2027 estimated compound annual growth rate. It's kind of like a defense contractor in a certain way, except they are a supplier to the defense contractors and the commercial transport manufacturers, but they're selling the picks and shovels to those industries rather, right? Um, Now let's talk about in-plant and industrial equipment. Uh, their visual for that is just some sort of factory solutions for factory infrastructure, um, hydraulics, air and water, HVAC. So they're selling components to actually build out the factory, but then also the factory equipment itself, the machines that are performing the production, assembly and testing, machine tools and presses, product transfer and automation. So here's what's sexy to me about this. According to them, macro growth drivers, mega projects, so infrastructure, industrial capex investment, digitization, and AI are driving the need for semiconductor fabs and data centers. So hardware is a big theme right now. You see the stock price of Nvidia, you see the stock price of Broadcom, Taiwan Semiconductor. You see at Lam Research, ASML, KLA, Applied Materials. For some reason, those are sold off pretty hard. Anyways, I could not agree more. Digitalization and AI driving the need for semiconductor fabs and data centers. So, what is Parker Hannifin doing to benefit from that? Well, this is just a graph of mega projects announced. So here's kind of what they're talking about. This is kind of like the growth ahead or potential growth ahead is what they're saying. So they're saying out of all these big projects, it doesn't define what a mega project is, but out of the $1 trillion of mega projects announced, looks like about a quarter are power generation, um, chemicals like, rare earth metal sourcing, stuff like that. It sounds like power generation, semiconductors, data centers, and maybe some of these are an end market for Parker Hannifin. Um, Again, if we take a look at some of these products, you can imagine all of the various end use cases that these products have just when you're building stuff. Furthermore, the expertise of this company positions it to be able to build new products to be able to serve um, in semiconductors, whatnot, that don't even exist yet. So that's what they do. Let's just go into the history a little bit more out of curiosity. Let's talk about this company was founded in 1917 as a machine shop that built pneumatic brake systems for trucks, trains, buses. Here's a couple of fun facts. Um, the fuel system in the Spirit of St. Louis, the plane that Charles Lindbergh uh, flew across the ocean on the first transatlantic flight. That began the relationship with the aerospace industry. Pretty cool. That is the fuel system right there, I assume. Um, Here's what else is interesting right here. Parker responded to World War II by focusing on just one customer, the US government. As a result, Parker grew from 910 to 2,600 employees in a year. Sales increased 700%. So this company benefit from the war effort, as many did at that time. And this is sometime in the 50s, it looks like. Parker acquired the Hannifin Company, a family founded manufacturer of cylinders and valves. Now Parker could supply all the components in a fluid power system. So, what has been going on this whole time? Um, Parker controls were used on every space mission, including the historic Apollo moon landing. Interesting, right? This company. So why am I highlighting this? I'm highlighting this because these are some pretty iconic moments, some pretty iconic products or use cases for their products over the years. if you're a manufacturer of airplanes, if you're building industrial machinery and you need components, you need companies you can trust, of which, of course, it does seem that this is one. This company's been around for a long time and has some pretty iconic moments, seems to pass the smell test. So, does this company have a moat? Well, I don't know. It seems to me, if you look at these products, there's a lot of pretty nichey products in here. Maybe they could have the moat of one particular product. It's kind of hard to gather from just looking at these things. However, I could see how if they do make a specific piece of equipment that's very critical to a specific airplane, machine, whatever, how they could build a small moat around that one particular product that creates switching costs for the manufacturer. Does that mean that they have a moat around all their products? Let's take a look at the Morningstar report to kind of confirm or deny that. Just interestingly, Morningstar gives it 1 out of 5 stars, saying that it's 50% overvalued. They say that it has a narrow moat. Let's just read a little bit about that by Nicholas Lieb here, our friend at Morningstar. So let's see what he says. We assigned Parker Hannifin a narrow economic moat rating based on switching costs and intangible assets. Parker's returns on invested capital fallen close to its cost of capital a few times over the last decade. That's stuff that I don't really care about. It separates his business into 2 segments: industrials and aerospace. Firm holds number 1 or 2 share in many of its markets, summing to create one of the widest breadths of industrial components globally. We think the diversified industrials segment, representing around 2/3 of revenue, merits a narrow economic moat rating derived from switching costs and intangible assets. The diversified industrial segment houses a diverse array of product lines such as hydraulic, pneumatic, electromechanical, sealing, filtration components. They're installed in systems of passenger and commercial vehicles, agriculture, construction, yada, yada, yada. Parker's components are critical to the system in which they are installed, but represent a small fraction of the equipment's overall cost. For example, the O-ring seal is essential for leak-free connections in high-pressure equipment, such as hydraulic cylinders and excavators. The O-rings, designed to meet the most stringent standards, can cost anywhere from a few cents to a few dollars. That's what I was saying earlier. A failed O-ring can be catastrophic, as in the Challenger explosion. We think it is difficult for a customer to switch suppliers once Parker's components are designed and installed in a piece of equipment. This cost to switch suppliers can vastly outweigh the money saved by switching due to operational downtime, lengthy product redesign, regulatory, so on and so forth. So, in other words, once the industrial machine is rolling, you've already purchased Parker's components. They work, they last for a long time. You have the ability with this company to come back, get them replaced, fixed. They're integrated in that way. That is the moat. It's not like other companies I've covered, like a Hershey bar. Like, it's not some iconic brand. It's just, it works. You've got a solution for it, and it's more brain damage to switch suppliers. That's where the growth is coming from with this company. So according to Morningstar, they have a narrow moat. I would describe it maybe even more lightly than that, but I digress. Why has this company performed so well over the last year if it doesn't have some sort of wide moat? Its financials look pretty good, but I think it's more stemming from the narrative around the end markets. Aerospace and defense has had a good run with geopolitical conflict as of late. There's a lot of positive sentiment driving that. But then you also have this narrative of like reshoring manufacturing, bringing manufacturing back, the infrastructure bill, all um, the semi fab in Arizona, but from Taiwan Semi, all of these things investing both in America, worldwide. There's a lot of activity going on globally. That's really driving these returns, I think. And there's this is a sexy stock right now, and you see here on the 3-year, outperformed the broader market almost 4-1. Wow, what a run! More than doubled the return of the market over 5 years, more than doubled over 10 years, and just crushed the market over the last 30. So yeah, this has been a big, big winner. Let's take a look at their numbers to understand why. The last video we went from 2019 because that was the extent, but here we're going back to our trailing 10 year. So 12.7 billion of revenue to 20 billion. Not bad. That's more than 50%. So that's like 60 to 70% growth. Gross profit 3 billion to 7.2 billion. Okay, what sticks out there? Gross profit is growing quicker than revenues. So there is a strong amount of operational efficiency going on there. That looks really good. Operating income from 1.5 to 4 billion. That's almost a triple. That's also growing faster than revenue. Operational efficiency. That looks really good. Shares have come down from 143 million to 128. That's almost 10%. Earnings per share on a diluted basis, 632 to almost 18 a share. That's basically tripling. The dividend per share, 237 to 622. That's pretty good. Earnings per share has actually increased more than dividends per share based on that mental math. In fact, we see that played out in the fact the payout ratio has kind of gone down over time. EBITDA, again, almost tripled. Phenomenal looking income statement, guys. Looks great. Let's take a look at cash, their balance sheet. We've gone 1.2 to 371 million. They had a big cash infusion. They must have sold one of their businesses or something. Interesting. So their liquidity has certainly gone down over time. They're holding more inventory. They've accumulated a lot of goodwill, long-term debt. Yeah, okay. So 2.7 billion to 6.7 billion. So we've really levered up this this company in that time frame and pulled a bunch of cash out. Our payout ratio has gone down. I know this company has made acquisitions. Interesting. I've never used this website before, so if it's not legit, it's not legit. But let's just take a look. Megit significantly expanded. So that's one of their business units, bought for 9 billion. Okay, so without doing more analysis, it does appear that there's a couple clues here. Cash being down, goodwill being up, and debt being up. It does appear that we are using the cash. It does appear that the cash has been used along with debt to buy acquisitions. It does appear to be working, but yeah, not a lot of cash per share. Again, the most recent trailing 12, 288 a share versus our value here. So balance sheet, the balance sheet, it's not bad. The income statement looks great. And then last but not least, let's take a look at the dividend. Look at this, 68 years of dividend payments. In fact, it says 8 years of dividend growth, but that doesn't sound right. Parker Hannifin dividend growth streak. I know. Yeah, here we go. Parker has increased its annual dividends for 68 consecutive years, among the top 5 longest running dividend increase records. So it is a dividend king. All right. Let's take a look at growth. From February to May 2024, they grew their dividend by 15 cents a share. That is a little bit more than 10%. 15 cents over $1.48. Yeah, that's 11 or 12%, something like that. 15 cents here, 30 cents here. They've had substantial dividend growth, 17% over the last 3 years, 12% over the last 10. Really strong dividend growth, looking real good. The dividend is very, very safe, according to Seeking Alpha. Let's take a look at some of the valuation. We'll start with the free cash flow yield, low fours, high threes percent. It seems fairly low, but not egregiously low. The dividend yield is essentially the lowest that it's been in the last 10 years. To me, that indicates, overvaluation just on a yield basis. Look at this yield on cost. If you would have bought on January 9th, 1995, your yield on cost would be 70%. I'd love to talk to you about your riches. Let's take a look at the valuation metrics. 28 times earnings. That's expensive sounding for a company like, I would honestly expect a company like this to be trading at 20, maybe 25 on the high end. Another company I covered that's industrial, a lot different than this, but industrial, Otis was trading at 25 times earnings, and that seemed expensive to me on a forward non-GAAP basis. Price earnings growth gap 1.26, still less than 2 on a forward basis. The price sales of 4, not bad for a company like this. Their valuation, maybe we should just compare it. We should do it on a relative basis, is what we should do. Let's take a look at that. Here is their price earnings gap over time. That's 10 years. This usually takes a little bit to load. So it's kind of been up and down. That is multiple expansion. Maybe we should go back to the 10-year. January 7th, 2015, trading at 17 times, 28. It's just kind of trended up. Now, is it the highest that it's been? No, in fact, it was substantially more in 2023, a little bit more late 2020. It was higher in 2018. It's not at the highest that it's been, but it's on the higher end, and if I were to draw a average line, it would go right through the middle and be going from lower left to upper right. It does appear that the valuation of this company has benefit from multiple expansion over time. So is this a good deal? Well, I don't know, guys. Let's take a look at this. Okay. So this is the most recent earnings report. We looked at it earlier, dated October 31st, 2024. So earnings are coming up here in a few weeks. All right. But this is the most recent report. It's been almost a quarter since this. Let's take a look. So sales in diversified industrial were down 5% in North America, 2.4% in international. Operating margins were up and flat, respectively. Order rates. So I won't worry about order rates. I'll just worry about sales and margins. So diversified industrial it came down. So that's from the prior years for Q1. Diversified industrial down, aerospace up. We got 2.1 billion here, 1.4 billion here, so that's 3.5 billion versus 1.4 billion of aerospace. Aerospace is much smaller than diversified industrial. It's also growing at not only did it grow 17%, but margins were up 190 basis points year over year, and order rates were up. So it does appear that the growth story in aerospace is reporting well. How is that translating to the entity-wide performance? Well, sales were up slightly. They had 80 basis points higher margins, 1% higher orders company-wide. So this is really dragging. What's interesting is the diversified industrial piece, that's like what I'm excited about, because that's where the long-term growth story is in my monkey brain, right? Doesn't appear that that's played out last quarter. So is that confirmation of a new trend, or is that just weakness quarter over quarter? I don't know, but that gives me a lot of pause as an investor. I do have a position in this company. However, I'm not a buyer here because looking at these numbers, I don't see anything that makes me particularly excited. In fact, I see a reason to maybe have some pause. We're seeing this very, very simplified analysis. We're seeing some weakness really in the core segments. Aerospace is the growth story. If that continues, great. But 1.4% sales, higher margins. Here's the real story here. Operational efficiency is what's driving returns. You've got 14% growth in cash flow from operations, 17% in free cash flow. So despite fairly anemic overall sales growth, their operational performance, their profit growth is phenomenal. So I think that's why that gives credence to what we saw. Okay, where was I? So here is their guidance. All right, 50 basis point to 3.5% sales growth. I'm not actually sure what the difference is between reported sales and organic sales growth. The earnings per share here, I just got to wrap this up. Okay, adjusted earnings per share 26.35 to 27.05. How does that reconcile? This times 4 is 24.80. 24.80. So that's like high single digits. 24.80. Yeah. So they're forecasting for like high single digit earnings per share growth. If you have been observing astutely, you will notice that that is lower than the 5-year dividend growth rate. In other words, it is conceivable to think that the next time they raise the dividend, it will not be quite at the rate it was, at least in the last 2 raises, definitely not the last 3. Or maybe it's the exact same amount of cents per share, but is a lower amount. So what I'm looking at here is I'm looking at numbers that don't really align with. I was about to say that the growth, at least over the next year, it looks lower than it has been the last few years. That's what it looks like. The stock has really performed well the last few years, but I don't want to say it's gone parabolic, but really from bear market lows here of late 2022, which it didn't really sell off that much, 15, 20%. From that time, it has more than doubled. Earnings haven't doubled, okay? So is this valuation 24 times, 28 times earnings, trailing 12, 24 forward? Is that super expensive compared to a lot of stocks in the market? No, not really. It looks to me like the stock's gotten a little ahead of itself. And full transparency, I did when I bought the stock, it was here. I started accumulating shares here when it was at the low 500s. Just, I mean, gosh, that was 30% ago, right? So the stock looked expensive when I bought it the first time. I think I have 2 lots, but I'm not a buyer here because it has appreciated quite a bit, and the fundamentals, in my mind, don't look amazing. it hasn't, the underlying business hasn't grown by 30% in that time, but the stock price has. So I grade this a whole. I like the diversification that it has in the end business units. I like its exposure to all of these end markets. While I wouldn't classify it as a wide moat investment, I do tend to agree with Morningstar's investment, and it's kind of, logically spring forth from my mind that you create these specific components, your customers begin to rely on them, and I run a business. Okay, once I have a supplier for something and it works and it's effective and the cost is good and they're easy to deal with, I don't I'm not looking to switch. Okay, so it makes sense why a business like this would grow. I think they have exposure to the long-term secular story that I believe in, which is onshoring, manufacturing, electrification, and hardware is kind of the current theme of our economy and of markets. And I think that this stock approximates that on like a second to third order basis. So obviously, I liked it enough to purchase it prior. However, I believe that here it does look relatively expensive, and I'm not a buyer here. However, I do like the company. It's obviously very well managed and has been a very, very strong performer over time. So, what are the risks? There's two things that spring to mind. One, the valuation. It's run up a lot in the last few months. It could run down a lot. This does not. This stock strikes me as being cyclical. It sells components that are used in a broader range of industrial applications. Therefore, it's exposed to the business cycle. All all businesses are, but it does seem like it's fairly exposed to business investment. So that's what you're attaching yourself to is basically a capex, an infrastructure investment cycle. So the risks are that that type of spending slows down due to an economic contraction. So I don't necessarily believe that this stock is recession resistant. And is that borne out in the price? Well, yeah, we see here that when the market sells off, so does this stock. And it has outperformed in the bull phase. This stock, it either underperforms or market performs when there's a drawdown in the broader market. Obviously, it's been a compounder. So, yeah, if this stock, I think you're not finding safety in a bear market in this stock. It either sells off in line with the market or more severely. It is what it is, right? Um, it does appear, just visually looking at the chart, that it has a higher beta than it has a beta greater than one. It's a growth stock. I would expect growth stocks to trade or to have earnings growth at low double digits to mid, teens double digits minimum, um, to justify that kind of price action. I'm just not seeing that from this stock. So the risk, it's pretty straightforward. There's other risks also as well. Tariff risks, if we're manufacturing these products here in America, companies want to buy them, impose tariffs. Um, Obviously, there's a lot of metals used in these components. Maybe we're sourcing those metals from somewhere else, depending on where the the manufacturing facility is. There's that. So there's tariff risks are unclear. I would just monitor the situation with that and make an assessment at that time. You can't really quantify that right now. There's that element. There's the cyclicality of it. I think it's just a classic cyclical stock. And then the valuation of it. This isn't one of those stocks that I look at and I'm like, yeah, I'm riding out the depths of a bear market and outperforming in this stock. That's not what I think. So the S&P's gone up by at least 20% the last 2 years. This stock has gone up double the market in that time frame. Does that mean it'll drop harder? Not necessarily, but just something to consider with this stock is, yeah, If you believe that this stock is more volatile than the market, which data shows that it is, in a bear market, it will not do so well. So just something to consider. Those are the risks. So with that, I consider it to be a hold. I think it's a quality company, clearly, but not the kind of company that I'm accumulating at this stage in the market cycle. I was 6 months ago, but it was at a much better price, and I wanted exposure to more growth at that time. It's different. I'm allocating more of my portfolio right now to value. So let's just conclude the video by doing technical analysis. Again, look at this chart. You see how it's just exploded up as of late, and that is clear to see by the fact that these lines here have been getting. See how these lines are getting steeper and steeper? That implies multiple expansion, right? Just visually. So wow, this is a bullish looking chart, right? It's very bullish. Unironically, if you were going to enter into a position in this stock right now, you did believe in the growth story, you say, hey, this stock is going to continue to go. It's bouncing, or it might be bouncing off this trend line here. I guess right here maybe is the better place to put it. Again, I accumulated right here. It's done well. If it bounces up, great. It might break down further. I don't know. I think once it were to start consolidating, it would start to look more compelling to me. Just assuming that it continues to grow earnings. But yeah, it's just a bullish looking chart. The market loves this stock, and this looks like a pretty good entry point if you assume that that bullish momentum will continue. If you love this company so much, you want to establish a position, you just want exposure. Yeah, this is probably a good entry point. If you're like me and you've already allocated and you're just kind of waiting to see what happens, then that doesn't mean it's not a good entry point. How about that? It's just the chart just continues new and new ascending levels of bullishness. That can't continue forever, right? Well, it can. But when a company's growing by single digits, why would it? But stranger things have happened. So, yeah, I do think that this is a good entry point, just visually looking at the chart. But again, I'm not grading it a buy, I'm grading it a hold. So, do with that information what you will. So, that's going to conclude our video today, our analysis of Parker Hannifin Corporation, ticker PH. If you found this content useful, interesting, and informative, then please consider liking this video, subscribing to my channel, and commenting below with your thoughts. I really enjoy doing this. It is a passion of mine, and I'm very interested in markets. So if you are too, I definitely would like to, interact with like-minded individuals such as yourself. So please comment on the video and get in touch with me. Who knows? I may just respond. I'm always open to suggestions on things to cover on the channel. So if you're wanting me to bring my approach to a stock you're interested in, then please comment it below. I actually do have a couple that I need to get to, viewer suggestions that I need to do. I think my landlord is here to take a look at something. Hopefully you found this interesting, and I will talk to you soon. it doesn't.